fundamental. So we'll be looking at some of these very fundamental principles. These are generally covered in managerial economics, but they are equally relevant to finance and the world of business. So, Harsha, I'm just putting up the. So I'm putting up the presentation, what we have, and I'll just ask you if you have heard of these concepts before. Okay, so first, let's start with. Okay. So let's see if you've heard of this, the incremental concept.
A bit heard of.
Okay. Time perspective, this you know. Time perspective, you will definitely know. You may know it under a different name, that's all. This you definitely know.
Yeah.
And you know this also.
Discounting.
Yes. Anjali is here. Very good. So let's get Anjali and ask her if she is aware of how many of these she is aware of. Anjali, can you hear me?
Yes, sir. Good evening, sir.
Good evening, good evening. So Anjali, tell me, today now we'll be looking at many of these more, very fundamental concepts in business and finance. So if you take up a managerial economics book, you'll find these things. In one way or the other, these things will also be there in any finance textbook also. So here, how many of these concepts are you familiar with?
Discounting opportunity cost.
Mm-hmm.
I know it. The incremental concept I've heard for the first time, and time perspective I know a little bit. Like I have a little bit knowledge about that.
Excellent, excellent. So we'll start with the first one.
Yes, sir.
And here's the last one first. The equi-marginal principle. This is once again something which, if you have ever done a bit of economics or something, you would find this particular concept there. So fine, let's start straight away with the incremental concept. So we'll try to cover all these things with examples. And then if there is time, we'll move on to the next or let's say the next chapter of this unit. So first thing is that why are we looking at this concept of this incremental concept? Why is it important? It's important in managerial economics, but it's also very important when we consider it in the light of the strategy of firms. So remember the first two units that we've done. First unit we did was pure strategy. We just talked about strategic stuff, what are the different impulses that the CEO has and things like that. Then we spoke about wealth maximization and all, once again, related to strategy. This is, these concepts here, which we'll be speaking about, these become relevant because the MD of a company, these are like tools for him. He has to use these in taking his decisions. So all the things that we'll be doing today, if we cover it all today, great, otherwise part of tomorrow, is going to be about these various tools which help the MD of a company or anybody taking a decision to take the right decision. So the first thing here is, so this incremental concept is closely related to the concept of marginal cost and marginal revenues in economic theory. It sounds very, let's say, what shall I say, academic, but it's a fairly simple concept. Any idea what marginal cost or marginal revenues are? Anjali, any idea about this? Have you heard of this concept before? Anjali? So I was saying, have you heard of these concepts before? Marginal cost, marginal revenues.
Yes, I've heard about marginal cost and marginal revenue as well.
What are these?
Marginal cost is per unit cost of production, and the same goes with marginal revenue. It is the per unit revenue received received to a farm.
Okay, but let's look at it like this. See, when you say marginal in economics, basically it means what is the cost of producing one extra unit. Let's say that you are producing 100 units today. Now, suppose I want to produce 101. You're, let's say, at the limit of your capacity at 100. I want to produce one more. What will be the cost that you will incur for producing that one unit? That is your marginal cost. You can think of it, as at the margin. You've already, sort of reached this point. You want to expand this a little. So what is that extra cost? And in marginal revenue, if you make the sale of one extra unit, what will be that extra revenue that you will get? And in this slide, what we are basically saying is, we are using the words incremental to substitute for marginal. So incremental makes it even clearer. Increment is that additional thing, something which you do in addition to what you're doing today. So look at this. Incremental cost denotes change in total cost. So what is total cost here? Let's say if you want to produce something. Now, there are two types of costs very generally which you can think of. Some are those costs which are related to setting up the whole production enterprise. For example, you set up a factory, you put in machines, you brought in labor. There's a certain amount of fixed investment which you have done. Even if you don't produce a single unit, you have already made this investment. This is like a fixed cost. And then, depending on the volume of production, you buy raw materials, you have overhead costs, various other costs. You will have your selling and administrative expenses and all these things. And these are the costs that you actually have. Now, if you want to increase production, probably what will happen is that these variable costs which you have, the raw materials, the labor, the overheads, these are going to increase. So the total cost, fixed plus variable, will increase the moment you increase the volume of production. If you want to produce 50 units, the total cost of production, it will be, let's say, 100. If I want to produce, say, 100 units, naturally that total cost is going to increase. That is the point here. The moment I go for any extra production, there is going to be a change in the total cost. So what is the extra cost to the company in terms of raw material, labor, overheads? This will result in increase in total costs. So similarly, incremental revenue denotes a change in the total revenue. So what is the extra revenue that a company will earn from the sale of additional products? The moment you produce more, you will naturally have, and you are able to sell it, of course, your sales will increase. So the moment your sales increase, your revenues will increase. The total revenues that you get from running that company, that is going to increase. And the point here is, what is that increase factor? If you were at 100, you go to 120, then the incremental revenue will be 20. This is the basic concept of incremental. Now, if we continue with this discussion, incremental cost denotes change in the total cost. Incremental revenue will be change in total revenue resulting from a decision of the firm. Now, a decision will be considered to be profitable. Let's say the MD has decided to increase production. Now, if he decides to increase production, this particular decision of his is going to be profitable if it increases revenue more than costs. Can you see the logic of this? It increases revenue more than costs. That means the amount of sales that you make, as a result of that, the revenue that you get, that is more in amount, monetary value is more than the amount which you spent on producing it. So let's say the total costs were 100. You produced some extra units. It went up to 120. As a result of this, your sales increased. But if after the increase in sales is also 20, then you've not really made a profit. It's the same. Can you see this, Anjali? Okay. Second point is, it decreases some cost to a greater extent than it increases others. So basically, if if they take a decision to change the structure of the costs, like maybe the way they're marketing, they have a number of options, the number of ways of advertising, so they decide to forego some particular method and opt for some other method. So what is going to happen is, expenditure on one particular way of advertising or one particular way of selling the goods is going to go down, whereas the expenditure on some other goods, some other way of selling or advertising is going to go up. So if, let's say, the overall decrease in costs is less and the sales remain unaffected, then what is going to happen? Your overall revenues will increase. Or think of it this way, it increases some revenues more than it decreases others. So I'm selling many products. I take a decision which results in a change in the sales pattern. So some of the products that I have, the revenues from these products actually increase. But since I'm focusing more on these products, the revenues or sales from the other products, they decrease. But if the increase in the revenue is more than the decrease, then I've still gained something. Harsha, are you getting this? Okay, then it reduces costs more than revenues. So essentially, whatever decision you're taking, if it results in a reduction in costs, if let's say both go down, revenues also go down and costs also go down. But if costs go down more and revenues, by comparison, relatively speaking, go down less, then in that case, what you basically have is, once again, you have gained something. Now, to take this further, let's take a simple example. So some businessmen hold the view that to make an overall profit, they must make a profit on every job. The result is that they refuse orders that do not cover full costs, plus a provision of profit. This will lead to a rejection of an order which prevents short-run profit. Harsha, are you with me? So some businessmen, they feel that if we take an extra job, that extra job in itself should be able to generate a profit for the business. And it should cover all costs. So just to make that a little clearer, what is the incremental cost here? Think of it like this. If they take an extra order which is going to give them a revenue of 10,000. And they calculate the costs like this. To produce that many number of units, it will require the expense on labor will be 3,000. The expense on raw materials will be 4,000. The expense on overheads is going to be 3,600. Selling and administrative expenses are going to be 1,400. So if you add up all these, the total cost comes to 12,000. So 12,000 revenue, incremental revenue from the order is 10,000. So in a way, if you have this method of accounting, you end up with a loss of 2,000. Now, if you try to look at only the cost which was incurred, that incremental cost which was incurred as a result of the extra units that you produced, and if there is a situation where you have idle capacity, that means you have the capacity to produce more. The labor is there, the whole selling infrastructure is there, the raw materials, of course, will increase. But basically, you are in a position to produce more. If, let's say, if this is the situation of your company, so the unit has idle capacity, then if that is the case, then you will find that it may make sense to take on an extra order for a short-run profit, because your actual expenses are going to be much less than what it would have been if you did not have idle capacity. See, your labor is already there. To push them a little more to produce those extra goods, you basically have to spend an extra 2,000. Raw material cost is going to remain the same, 4,000, that is not going to change. The overhead costs are going to be less because you're already spending on overheads. So if you're just expanding it a little, there is maybe a little bit of extra expenditure, but not too much. So that we peg at 1,000. Selling and administrative expenses in any case are covered. So the selling and administrative expenses are required to sell, let's say, 1,000 units is going to be the same as the amount required to sell 1,200 units. It's not as if you're going to get new salesmen or put in a new infrastructure, nothing like that. It's going to be the same. So the full incremental cost actually comes to only 7,000. Now, the incremental revenue from the order is 10,000. So at the end of the day, you end up with a profit of 3,000. 10 minus 7, you get 3,000. So this, if you look at it this way, it sort of changes. So I've tried to explain it here that labor was being utilized fully. So the cost of additional labor goes down. Overheads, only a small increase in items like power, spares, lubricants, etc. Selling expenses, no change as the company is already promoting the same product. So what happens is, if I look at it in terms of incremental cost, I can then see that it is maybe good for me to take take on additional work, utilize my idle capacity, and make some profit out of that. Otherwise, it was lying idle, it was not being used. Here is a chance to increase my sales. I hope that's clear. Harsha? Okay. Now let's take the second example. It decreases some cost to a greater extent than it increases others. So some costs are reduced, others are increased, but not to the extent of the decrease in the first one. So let's take an example from the selling expenses. So let's say a company is spending 1 lakh on advertisements, and it decides to reduce this by, let's say, 60,000. Now, when it reduces this by 60,000, obviously, the visibility of the company is going to go down to some extent. So how does it compensate? It decides to compensate by, telling its dealers to push its product. And in return for that, they say that we'll give you an extra incentive, and they calculate that that extra incentive is going to be 30,000. So basically what happens is they were not giving this incentive to the dealers before. So the 30,000 here represents an increase in the expenditure. But they have reduced the expenses on selling from 1 lakh to 60,000. So they have actually reduced it by 40,000, whereas the incentive has increased their costs by 30,000. So basically this cost has resulted in, this a reduction in cost of 10,000. Overall, if you sort of, compare these two, what you see is that costs have been reduced by 10,000. So this is the point to look at here. So by doing this, I end up in increasing my profit. All I've done is I've changed the pattern of my expenses. I have decreased some of my costs. I have increased some of my costs. And in the process, I have reduced overall cost, total cost, and that has led to an increase in profit. The assumption here is that my sales are going to remain at 10 lakhs. Now it increases some revenues. This is another, the third principle here. It increases some revenues to a greater extent than it decreases others. So in this case, look at this. Suppose a company is producing and selling two products, soaps and detergents. Now this company can increase the advertising on soaps and reduce the advertising costs on detergents. It's up to the company to decide how exactly to promote its own products. So as a result of this, the sales of soap goes up by rupees 5 lakhs, but the sales of detergents goes down by 4 lakhs. So because they changed the advertising structure or the focus of the advertisements, basically what has happened is the sale of soap has gone up because they're giving more weight to the ads on soaps, but the sales of detergents have gone down. So the incremental cost of ads on soap has gone up, but incremental revenues have increased by 5 lakhs. So it's been worth it. They've put in more they've given more attention to soaps. They've managed to get more revenue. Incremental cost of ads on detergents have gone down. So they've actually reduced the amount of, advertising they're doing for detergents. And incremental revenue has declined as a result of that. But the decline in incremental revenues for detergents is less than the increase in incremental revenues from soaps. So basically what happens is you end up with an extra revenue of 1 lakh. That is the point which we are trying to make here. Harsha, are you getting this? Okay. So that brings us to our next concept, the concept of time perspective. So the time perspective concept states that the decision maker must give due consideration both to the short-term and long-term effects of his decisions. So what he has to see is what is the impact of the short run decisions that he takes and long run effects of decisions on the. So what is the impact of the short run and long run effects of decisions on revenues as well as costs? So there are certain decisions which he can take which will have a short-term perspective. There are some that can have a long-term perspective. So it's up to him to see what are the trade-offs here. So in the short period, the firm can change its output without changing its size. let's say the firm has a certain amount of capacity. Let's say it has the capacity of producing 10,000 units. It's presently producing 7,000. So it's possible for the firm to increase its output from 7,000, but there is a ceiling of 10 because that is the total capacity which it has. So the most it can do is it can go up to 10,000. So it can change its output without changing its size. That is not going to change. The size of the firm is that of a firm which has a capacity of 10,000 units. Now, the output of the industry is therefore fixed because the firms cannot change the size of the operation and they can vary only variable factors. So if you look at all the firms, within a short period, they cannot suddenly hike up their total output because basically they are restricted by the capacity that they have. So that capacity, if you want to increase that capacity, that has to be a long-term thing. It cannot happen in the short term. So each firm has a certain capacity. They are restricted to producing within that capacity. In the long period, the firm can change its output by changing its size. How does it change its size? It makes fresh investments, brings in new machines, sort of ramps up the entire scale of production. And as a result, the total output increases. Now, other firms in the industry, if they also over a period of time see that they can sell more goods and they begin to increase their capacities. So basically, over a period of time, what will happen is all firms together can increase their output. So that can only happen in the long run. Short run, you can increase the output, but you are restricted by the total capacity that you actually have. So let's take an example. In the short run, what happens? So suppose a firm having a temporary idle capacity receives an order for 10,000 units of its product. Now, the customer is willing to pay rupees 4 per unit. What the customer is saying is that we'll give you 4 rupees per unit or rupees 40,000 for the whole lot, but no more. So normally, this particular company would be selling it for much more than this. Now, they have idle capacity. They sort of examine this and they see that the incremental cost per unit is going to be rupees 3. The guy is giving them rupees 4. So they say that, okay, fine, we're going to make a 1 rupee profit per unit. So essentially what is going to happen is we will be able to make, our revenue is going to increase by 40,000 and our profits are going to increase by 10,000. So in the short run, they have definitely, if they take this decision, they will end up with a profit. Now the point is it as simple as this? For the guy taking the decision, is it as easy as this, that I simply use my idle capacity, I sell the products at a cost lower than I normally sell it, and I make a profit? See, there is an inherent problem here. Once you reduce the price, it is reasonable to expect that customers who you've been selling to already in the past, they will also expect you to sell to them at the price at which you sold to this particular buyer, who was basically someone you'd never dealt with before. He came, he offered you something, he drove a hard bargain, and you agreed. So basically what will happen is they are going to face certain repercussions in the long run. Now, it may not be able to take up business with higher profit margins or contributions in the long run. So going forward, if they try to go for a high profit margin as they used to, they're going to find it difficult to find buyers because they'll all be asked to basically look back at what is the deal they gave to this particular buyer. So the image of the firm may be spoiled in the business community. You see, basically they'll say that this firm is an opportunist and it sells to us at inflated prices. But whenever it gets a chance to sell to someone at a lower price, even though that is not a regular customer, they do that. So other customers are going to demand a lower price. And you think of the implications of that. So just for this 10,000 profit, you have basically spoiled your entire pricing for the future. And if you now try to bring back the pricing to the old level, you have a serious problem. Now, the long run effects of pricing below full cost may be more than offset by any short run gain. So whatever gain you get, the long run effects are going to sort of be much worse for you. That's the point here. And this is the concept which you really have to think about. When you think long term, you think short term, you have to look at these trade-offs. If you go for a short-term thing, is it impacting you adversely in the long run? Because if that is happening, then you have a problem. Okay. Now we come to another well-known concept. We covered a bit of this in our last unit, but I just want to sort of, reinforce this with a few more examples. So let's take this. So resources are scarce. We cannot produce all the commodities. For the production of one commodity, we have to forego the production of another commodity. So you would like to produce a whole range of products. But given the resources that you have, the resources would be the let's say your own capacity, the human resources that you have, financial resources that you have, it is not possible for you to produce that entire range of products that you would like to. So the calculation of opportunity cost involves the measurement of sacrifices. So basically, you will have to choose. So the moment you choose, let's say option A, you are sacrificing option B. So it's possible for you, let's say, to produce products A, B, C, D, E. This is the full range. But if you choose for A, B, and C, you will have to forego producing D and E. Because your resources only permit you to, let's say, produce 3 of these things. So whichever 3 you choose, you will have to sacrifice the other 2. So the sacrifices may be monetary or they may be real. So the opportunity cost is termed as the cost of sacrificed alternatives. So this is the thing to remember. Opportunity cost basically is all about choosing. So you have an option, you choose one, you sacrifice the other. So the cost of the alternative that you sacrificed, that is your opportunity cost. So you have 2 options. You can invest at 7%, you can invest at 8%. If you choose 8, you have sacrificed 7. Now, if for some reason this 8 tomorrow turns into 6, it doesn't turn out to be as good as you thought it would be, then you will remember that you had a safer option at 7, but you sacrificed that. Now, so opportunity cost is the cost of the sacrifice of the best alternative foregone in the production of a good or service. Therefore, if they are used to produce one thing, they have to be withdrawn from the other uses. So just summing that discussion up. So it is the opportunity missed or alternative foregone in having one thing rather than the other, or in putting a factor of production like capital, labor, etc., to one use instead of the other. So when we say factor of production, we're basically talking about the resources that you have, the human resources, the financial resources. So those are the factors of production. You have options. You can use them in, let's say, as suggested by option A, or you can use them in a different format in option B. If you choose A, you sacrifice B. Let's take an example. If I outsource production of goods, I can earn more, but the quality suffers a little. Let's say this is one example here. I have two options here. I can either produce the goods, or I can basically buy the goods from a mass producer of goods. So if I decide to outsource, I am freeing up my resources for some alternative use. I can use the resources that I would have used to produce these goods for producing some other goods and make an activity and make an additional profit from the production of those goods. So the opportunity cost of outsourcing, but if in the process of producing these goods, my mistake there. So, but in the if in the process of outsourcing the production, you actually end up with getting goods which have a lower quality, then you have a problem. So the opportunity cost is that if you outsource, there is a chance of losing the reputation for good quality goods in the future, leading to a reduction in future sales. So you can outsource, but if you outsource, it is very possible that the other option of producing the goods on your own and then making a profit from the sale of those goods, you lose that. And the quality which you could have maintained, for that, you actually lose that part. Okay, so that's one. Let's look at it. Another simple example here. So the cost of using land for wheat growing is the value of alternative crop that could have been grown. So maybe you could have grown something like some millet on it or rice on it. So if you choose wheat, you sort of lose out on the other. From a laborer's point of view, the real cost of labor to the laborer is what she could get in some alternative employment. So you're employed in a particular, let's say, organization. What is the cost to you? The cost to you is basically, if you had taken on a different, job, what would you have earned there? That is the opportunity cost for you. The cost of capital to the capitalist is the amount of interest he could have earned elsewhere. So basically, if it was possible for a capitalist to earn 10% in an alternative investment, instead of whatever he's doing right now, then he chose, let's say, a different investment which promised 11, but there was a chance of getting 10. The basic opportunity cost here is the 10% which he sacrificed. Now, we now come to our next concept, the discounting concept. So since the value of a rupee receivable in the future is less than the value of the rupee in hand, all future receivables have to be discounted to a certain their present value. So we've discussed this in the past. So basically, to a certain extent, this is a revision of what we've done before. And so when evaluating the profitability of investments, the concept of net present value becomes helpful. Because essentially what we're saying here is that if you're receiving inflows or receipts in the future, if you're getting cash flows in the future, they have to be discounted to their present value if you are to make an informed decision. So net present value is a decision-making tool for the CEO or MD, as it allows the CEO to assess the profitability of alternative investments using the concept of present value. So we'll be looking at this in great detail today. The basic takeaway here is that, see, the basic takeaway in the discounting concept is that anything receivable in the future has to be brought down to its present value. So we discussed this in the last unit, and we'll be looking at net present value in much more detail in the next part of this, this lecture we're having today. So we'll discuss it at that point. So now we come to this concept of the marginal concept. So the marginal word here is, once again, it's related to that marginal cost and marginal revenue. Of course, means equal. So we're looking at this part. And so the principle states that an input should be allocated so that the value added by the last unit is the same in all cases. So that may look a little, abstract, but if you approach it to an example and then understand it and then come back and read this, you'll get a better idea. So example, a firm has 100 units of labor. So this is the input here is labor. The firm, the firm in our example, it has 100 units of labor at its disposal. And the firm is involved in 5 activities: A, B, C, D, and E. So each of these 5, you can think of them as different goods that they have, which they produce. And the choice for the firm is that it can increase the production of any of these products here, A, B, C, D, and E, by employing more labor. But if it employs more labor in one, it sacrifices that chance of increasing the output of other activities. So it's up to the firm to make a decision here. So let's take an example like this. Let's say Maruti recruits 100 engineers. It's producing 4 types of vehicles. So how should Maruti deploy these engineers? So we just let's look at it like this. So it has 4 vehicles that it's producing. It has 100 engineers to deploy, and it decides to deploy them equally across all 4 types of these products. So let's say one product is the Swift, one is the Alto, one is the A-Star, and one is the S-Cross. And they decide to deploy 25 engineers for the production of Swift, 25 for Alto, 25 for A-Star, and 25 for S-Cross. And as a result of this, their profits increase by 100 in the case of Swift. I'm sort of going a little, cutting out the steps in between, which would have been an increase in the sales of this particular car. As a result of that, you get more profit. So the sales of Swift and Alto increase. Maruti ends up with an increase in profits of 100 in the case of Swift, 100 in the case of Alto. In the case of A-Star, the same number of engineers are employed, 25, but the profit increases only by 25. And the same is the case with S-Cross. So basically, the sales have increased for these 2 vehicles also, but not to the extent of the increase in Swift and Alto. So basically what happens is that if the person who took the decision, he has to now go back and think, has he made this deployment correctly or not? Because when he deployed these engineers in Swift and Alto, he was able ultimately to sell more of those vehicles and get a higher profit. But when these engineers were employed in, like making A-Star and S-Cross, what happened then? the sales increased, but not to the extent it increased in Swift and Alto. And then basically what happens is he will begin to think, is this deployment correct or not? Am I losing something here? So at that point of time, the CEO has to probably reconsider the deployment decision. And while I'm giving this example to you in the case of production, this works equally well in service, in banks, everywhere. So you deploy people in branches, let's say in the case of a bank, where you will get the maximum business. If you deploy the same number of people in different branches, and you find that, remember, you're talking about extra people. So if you deploy the same number of extra people in different branches, and if you find that branch A they generates much more business than branch B, then there is going to be this question mark in your mind: did I do the right thing in actually sending extra people to branch B? And that's the same question which is going to be there in the mind of the CEO here. If this deployment of engineers equally across all the different categories of cars that he produces, is it correct or not? So what should they do? So ultimately, the thought will be, it would be profitable to shift labor from low marginal value activity, A cross, A star and S cross, to high marginal value activity, thus increasing the total value of all products taken together. Because ultimately what you're interested in is to increase your overall sales. So if, for example, the value of the marginal product of labor in Swift and Alto is rupees 100, while that in A star and S cross is rupees 25 and rupees 50, then it is profitable to shift engineers from A star and S cross to Swift and Alto, because that appears to be more effective. So if the marginal value of any of the vehicles is less, then it does not make sense to make additional investments in that activity. This is the basic logic here. Over a period of time, investments will only be made in activities that have the same marginal value. The optimum is reached when the values of the marginal product is equal to all activities. So basically what happens is, over a period of time, the deployment of these engineers are going to be in products which will ultimately result in the same marginal increase. Because the moment you find that the increase is less in a given product, you will begin to feel that the deployment that you made is wrong. So while this is an example from, like I said, this from manufacturing, you can see the same thing in different lines, in the service industry, in other industries. It's always like that. You try to get or deploy people where they will be most effective. The moment you find a different alternative, you will, which is much better, you will automatically move people there. So the principle is that you will ultimately be forced to deploy people or to deploy resources in a manner that the marginal value obtained as a result of the use of these inputs is equal in all cases. And that's why we call it the equi-marginal concept. I hope that's clear. So our next part here is NPV and IRR. Harsha, are you with us? Okay. So we will take a 5-minute break here, and then move on to these two concepts, NPV and IRR. We'll now get to the second part of this unit, where we speak about net present value and internal rate of return. So coming to net present value, so we've discussed the basic concept of net present value in our earlier unit. And there we basically said that in investment decisions, where you have to project the amount you will earn over the life of your investment. So there are certain basic assumptions which you start with. You have a project, you are going to make certain investments in the project. Let's say it's you're setting up a factory, and let's say that you will have to make an assumption with regard to the life of that particular project. Let's say it's a short-term sort of thing, and you see that the life of that project is 5 years. So you'll have to make an assumption with regard to the life it has and the money it will earn over its life. That's one. Life of the project, the amount of money it will earn over the life of its, the total amount of money it will earn, and when the actual inflows are going to be received by you. So there are a number of assumptions here. Only then is it possible for you to make a NPV calculation. So let's suppose you are an industrialist. You have an industrial unit and you want to buy a machine that costs 10 lakhs. So this is your additional investment. You already have your factory. You want to basically put in an additional machine. And you want to increase, let's say, produce a particular type of product. For that, you need a machine. You've been told, your market surveys tell you that there is a chance of making profits by selling this product, but you need a particular type of machine. So you say, okay, fine, we'll make this particular investment, we'll buy this machine. And let's say the machine costs you 10 lakhs. Now you're also told that how long will this machine actually be there, or how long is this market opportunity going to be there for you? So you estimate that for 5 years, it will be possible for you to sell the products that this machine will actually produce. And you assume, after giving thought to it, that you are going to make earnings of 3 lakhs per year. So if you're going to get 3 lakhs per year, 3 lakhs in year 1, 3 lakhs in year 2, 3 lakhs in year 3, in 4 and in 5, what is the total amount of money that you actually got? Is it simply 5 into 3, 15 lakhs? Or is it less than that? Can't be more, but is it less? Because some of this money is going to be received in the future. In fact, most of the money is going to be received in the future. So in that case, is it actually 15 lakhs that you're getting from your 10 lakhs? That means it's like a 50% profit that you're getting, or is it less than that? So somebody tells you that, look, there is another way of making money. Suppose we take that same 10 lakhs and we invest that in the bonds of another company. That company is offering us a 10% rate of interest. So if we do nothing, simply take this 10 lakhs that we have, put it in the bonds of that company, we can sit back and earn 10% per annum. So it's very clear what your opportunity cost is. Now, the question before you is, should you invest in this machine or not? So what I've done is, I've plotted all my figures here. So I say my investment is 10 lakhs. From year 1 to year 5, I've plotted the inflows that I'll get, the money that I will get from the project. This is 15 lakhs. But now what I've done is, I have discounted each of these inflows by the opportunity cost. So essentially what I'm doing is, I have divided this inflow by 1.1 here, 1.10, 1 the principal and 0.10 the rate of interest. Here I've done it by 1.10 to the power 2. here by 1.10 to the power 3, 1.10 to the power 4 in the fourth year, and 1.10 to the power 5 in the fifth year. And when I do this, I find that the 3 lakhs that I received in the first year has a present value of 2,72,727. The 3 lakhs that I received in the second year has a value of 2,47,934. The third year, the value is 2,25,394. The fourth year, it has a value of 2,04,904. And in the fifth year, it has a value of 1,86,276. So progressively, it's declined because it's received further and further into the future. The value in terms of the present value keeps getting reduced. Now, if I add all this up, I end up with a value of 11,37,236. So I get an NPV of 1,37,236. So if I do this investment, at the end of it all, I end up, even in present value terms, what I'm getting is a plus figure, 1,37,236. So it appears to be a profitable investment. Now, this is basically like, I'm just sort of revising the concept for you. We had done this last time. So you understand exactly what has happened here. Now, using this, let's proceed further. So let's say that instead of 3 lakhs per year for 5 years, the project gives me 1.5 lakhs over 10 years. So the total amount that I actually receive in terms of inflows is still 15 lakhs. So which is better then? And why? And the opportunity cost is again 10%. So now look how this works. If I sort of take it over a 10-year period, if I spread this over a 10-year period, I again use the same discounting method. So I've done this manually here. So what I find is that the total amount I receive, discounted. So I've received 15 lakhs, but discounted in terms of the times when they were received, I get a total present value of 9,21,685. And remember, we put in 10 lakhs. So what we are left with is 78,350. So essentially what is happening here is I can see that it's a loss-making proposition. So even though I've got 15 lakhs, in present value terms, I've actually made a loss. If I have made a loss, effectively speaking, it means that the actual internal rate of return here is less than 10%. So since the NPV is negative, the investment should not be made. So by changing the timing of the investment, we notice that the decision changes. When the same amount of money was received over a shorter period of time, it was possible for us to take a positive view about this investment. But the moment we begin to think of it as spread over a longer period of time, because of the present value concept which we are using, we can now easily see that this is not worth it if the amount I'm going to earn is going to come over a 10-year period. And it also means that the return from the investment is less than 10%. So it's useful to know the rate at which the cash inflows will be exactly equal to the investment. That is, net present value will be equal to 0. So if I can reach a point where this is exactly 10, if I know if this is exactly 10, what is the rate? So I'm using 10%. So what is the rate at which this is going to be exactly 10 lakhs? If I know that, that rate we refer to as the internal rate of return. So we will look at this in due course. Just remember the acceptance rule. If NPV is positive, you accept. If the net present value is negative, you reject. And if it's exact, it's 0. That means this is 10 lakhs. This is 10, this is 10, these two are equal. Then you can still think of accepting if you can see some other benefits from it, which may not be monetary, but which may relate to other factors. Maybe other stakeholders, are there who want that project. For you, it's not a loss-making thing. It's more or less you're getting back what you put in. You can consider it then. Now, you can do this calculation very easily in Excel. So what I've done is this 10 lakhs here, I'm writing things in thousands. So 1,000 is 10 lakhs. So the amount you invest is 1,000. So what I'd like all of you to do is you open up an Excel sheet. I've put the rows and columns here to make it easy for you. And you just write these figures there. So the first figure you're writing is the amount you actually invest. But note that there is a negative sign here. So the discount rate we assume in this case is 11%. Now what I'd like you to do later on is keep changing this discount rate. So when you write this, please remember to write 0.11 and then use the percentage sign on the taskbar. Use that to convert it into a percentage. Or if you don't want to do that, just leave it at 0.11, but don't write 11. Next, the time periods are given here. Year 1, year 2, year 3, 4, and 5. Assuming inflows are like this, 3 lakhs each year. If you now apply the formula, all you have to do is, see, B3 is here. So you select this, comma, select this, the discount rate, comma, and then select this whole range from B6 to F, to F6. If you do this, you are going to end up with an NPV of 111.18. So essentially what this is telling you is that if you make this investment, you're getting a positive figure of 11,800. So because of that, you can now sort of take a decision in this regard. So essentially, what I said in the beginning, what I'd like you people to do is do this in Excel, keep changing this rate and keep seeing how this figure changes. You'll find that in Excel, if this figure is a negative figure, it will appear in red. So the moment it appears in red, you know that you need not make this investment at all. It's a losing proposition. If you can also, sort of change these inflows here. So if you move, if you use different figures here, you can see how that impacts the net present value. And while for the sake of convenience, I've just taken the same amount, you can keep varying these amounts. So remember this, it's a very useful formula to remember in Excel. And this is something which is, it will be useful in different ways. Now, the advantage of the NPV method is that it makes the decision easy by calculating the returns in terms of the present value of the inflows. Now, to sort of, labor this point further, let's say a CEO has 2 projects in which he can invest. He has to choose on the basis of the net present value. He is going to invest 25 crores and his opportunity cost here is 7%. So you can simply do that same exercise. So instead of writing 25 crores, you can just write 25. 0.07 becomes 7%. These are your inflows. 6 crores in the first year, 7 crores in the second, 3 in the third, 8 in the fourth, and then 8 in the 5th year. If this is the case, you end up with an NPV of 4.73 crores, which tells you that this is the investment which is worth making. Now, if you look at project 2, you are investing the same amount, 25 crores. The discount rate is the same. The time periods for the life of this particular project is 6 years. And here, your inflows are coming like this: 6, 6, 7, 7, 7, and 8. So 6 crores in the first year, and moving up to 8 crores in the 6th year. Now, if you do the same NPV calculation, what you find is that the NPV here is 1.77 crores. So even though it's positive, if you have an option between project 1 and project 2, the CEO can very easily see that it is probably preferable to go for this. So this is where the NPV concept actually helps. It's very easy to do. This calculation which I've got here is done on Excel by simply putting these figures into Excel. So it's very easy. Like I said, do it yourself once. The moment you do it, you'll get confident. It'll be easy for you to proceed. Why do we discount at 7%? This is the opportunity cost, like I said in the beginning. Now, so what, if we know to sum up this discussion on NPV, what exactly have we done here? So it considers time value. The timing of the cash inflows is discounted. So remember, when we talked about the fundamental principles, one of the things we spoke about was the discounting principle. So this is where you're using. This is one. It considers all cash inflows of the entire life of the project. So it's considering all the inflows that you will get over the life of the project. It yields a net present value. It is possible to add the NPVs of different projects. Let's say that you're going to do a certain number of projects simultaneously. Then, if you want to understand exactly what will be the benefit to the company from doing all these projects, if you can discount all the inflows from each of these products to their present value, you add them up, it's possible to simply add them and get a figure which is good in maths. So suppose a project has an NP of 10 lakhs, project B has an NPV of 5 lakhs, both are positive, so they can be accepted. They can also be added to find out the cumulative benefit to the company for investing in these projects. So this is, there are many advantages of actually doing this. And since the whole thing is available so easily in Excel, it makes a lot of sense to use it. Now, remember that if the NPV is positive, the overall wealth of the company will increase. That's the wealth maximization principle. That's the basic thing which we discussed in the first unit itself. We said that whenever strategic decisions are made, the strategic decision, if it is wealth maximization, basically the decision has to result in an increase in the value to the company. And that can only be figured out in terms of NPV. Now, what are the limitations of this? So while these are many of the things which make it good, what are the limitations of NPV? So the first limitation, of course, is that it's very difficult to figure out, the cash flows over this period of time. Over this entire period of time, what will be the cash flows? That is an issue. And it is difficult to estimate the correct discount rate. Over a period of time, the opportunity cost can change. So, it's possible that you will get other opportunities over the life of the project. And maybe the returns from those opportunities will be different from the one you have today. So it's a little difficult in finding out what exactly is the actual opportunity cost. Another way out of this is that some people think that cost of capital can be the proper rate. The logic is that I borrow money from equity holders, from bond holders, from banks. So I can arrive at a average cost of capital. Once I get that cost of capital, if I can just be sure that whatever investment I make, I can earn more than my cost of capital, then it's worth it. So there is a stream of thought which thinks that instead of using opportunity cost here, you can simply discount it at the cost of capital, because this is something which is more certain. You know about it. And you can use that to overcome this particular problem here, estimating the correct discount rate. But this is actually very difficult, because the moment you say that you want to estimate cash flows over a long period of time, a long future period of time, your main issue is you will have to forecast sales. You will have to do it so accurately that you will be able to, and you will have to actually think about the price at which you will sell. Over a period of time, it's very possible that this price will change. So you will have to predict those changes in your prices also. So there are lots of ifs and buts in this technique. But bottom line is that if you can do these calculations, it will at least give you an estimate. It will give you an estimate. It may not be exactly true, but it will at least give you a trend. If this is what you're doing, this is what is the likely result. So do you want to do it or not? That's your final decision there. Because I hope you've understood this. Get back to me if you have any issues with any of whatever we've done here. It's not the last time we'll be discussing this. Going forward, there will be other occasions when we will be referring to NPV, and what we're going to do next, the concept of internal rate of return. So internal rate of return is the rate of interest, or the discounting rate at which the sum of the future cash inflows is exactly equal to the amount invested. This is the basic thing. Now, it tells an investor the actual rate of return that she will get over a period of time, and assuming a series of cash inflows over this period. So what is the actual rate of return which you're getting? So when we say that we'll be getting a certain amount of inflow over the next 4 years, 5 years, if I now get the present value of all these inflows, what is that final rate of return which I got? So that is so I'll show this to you in different ways. One, of course, was using the concept of investment, which we'll do. But there is another simpler way of doing this, for the sake of understanding. So think of a bond. So a bond is essentially a debt instrument. Let's say that a company wants to raise money from the public, doesn't want to go to a bank, and it's not interested in giving you a share of the company. So what it does is it issues a bond. So a bond is an undertaking from the company to repay the amount which you invest in it after a fixed period of time. It can be 5 years, 10 years, whatever, at a fixed rate of interest. So anybody investing in that bond will be getting that fixed rate of interest. That rate of interest that you get in the case of a bond, it's referred to as a coupon. So this rate of interest that you get, in this example, what the company is saying is, you buy bonds from me, 100 rupees per bond, we'll give you an interest rate of 15%, and we'll pay this to you every year for 7 years. At the end of 7 years, you will get back this money. Now, you want to know what is the return, keeping in mind that you will receive rupees 15 a year for 7 years. Okay, so the present value of each rupees 15 will be less as over the years 1 to 7. So, the purpose of me showing you this is you'll understand the 15% better. So it is difficult to find this manually, except by a trial and error method. Once again, if I do it in Excel, what I get is this. So I am investing 100. So as we did in the case of present value, you put the 100 here with a negative sign. From years 1 to 7, I am getting 15 rupees. But remember, I am getting back the 100 rupees in the 7th year, because the company said that we will be redeeming the bond in the 7th year. The bond has a life of 7 years. They took money from you, they invested it in the company, they paid you interest over this period of time. And what did you get? And you will get back this money in 7 years, and along with interest over that period. So if I calculate this IRR, what do I get? I get exactly 15%. So basically what I'm trying to tell you is that any debt instrument where the principal is returned to you on maturity, the present value of all the interest that you received and the amount that you got back, the principal amount, is exactly equal to the rate of interest that you actually pay. So you may not realize this. So if you're paying 15%, you will not probably think that this is going to be exactly equal to the discounted value of the interest that you will receive over the period of the debt instrument. So in this particular case, you have received this 15 into 7, 105 rupees, and you've received the 100 rupees back at the end. You've received a total of 205 rupees. What is the rate of interest? What is the internal rate of return? It is exactly 15%. So this is the thing which you need to remember. Any debt instrument, remember the catch is that you have to get that money back at the end. Any debt instrument, whatever rate of interest is offered to you, that is actually the internal rate of return. How do you get that? By discounting all the cash inflows that you will receive. What are these cash inflows? These are the interest payments that you receive. And in fact, if you do this exercise, I'll show you the formula in a little while. You do this exercise in Excel for any debt instrument that you have, you will find that you will get the answer. You'll get the exact rate of interest that was actually being offered to you. So the IRR will be the same as the coupon that they offered you. So remember this. Now, here's another one. You wanted to invest 10 lakhs in an industrial project. You calculate and you estimate the amount we'll earn each year as follows. So year 1, I am investing 10, year 0 rather. And from years 1 through 10, I am getting 1.5 lakhs each year. Now here, if this is the same example which we use for NPV, where we said that there we were trying to use this example to basically tell you that it is not worth investing because my opportunity cost was 11. Here, I was getting a negative NPV. Why was I getting a negative NPV? Because the actual rate of return is only 8.144. So how does this help me? It helps me because I now understand that I can actually find out the actual rate of return of my investment and compare it with my opportunity cost. So there are two ways of doing it. I can either do it by looking at NPV, or I can do it alternatively by looking at the IRR. Both of them are using the same method as such, but this gives you another perspective. So if you're making an investment, let's say you're the MD of a company, you're responsible to many different stakeholders, you would want to know these things. what is the actual internal rate of return? Should I invest or not? What is the NPV? You want to know each and every detail, and this is how it helps you. Now, when you compare this with the previous slide where we took the example of a bond, remember that unlike the bond in an industrial investment, you will not get your initial amount back. Whatever you've invested, you've invested. Maybe it will be possible for you to sell those machines to some other party, but that is an uncertain thing, not like the bond where you're getting your investment back. So you have to earn on a year-to-year basis. And whatever you earn, you discount those and you begin to find out what your internal rate of return is. Basic concept is, if the IRR is greater than your cost of capital, you accept. If the IRR is less than the cost of capital, you reject. And if the IRR is equal to cost of capital, then you may accept. So essentially, what we're trying to say here is that these are tools in the hand of the CEO which helps him to take these decisions. And when you actually, if you begin to take an interest in finance, look at the performance of other companies, listen to commentaries on that, of actual companies in India and abroad, you will find that despite all this, there are companies which are actually not being able to get their actual, cost of capital back also. That means the IRR of their projects is less than their cost of capital. Okay. This is another example, once again, to sort of reinforce whatever we've learned. So let's say the cost of an investment is rupees 10 lakhs. You can borrow the funds from a bank. The rate of interest is 9%. The life of the project is 10 years. For the next 10 years, it will give you a return every year. You need to know the rate of return of the project. If you know this, then you can decide whether to invest in the project or not. So you have an estimate of the cash inflows of the project, will generate every year for a period of 10 years. You use a simple IRR formula in Excel and you find that the rate of return of the project is 8.144, as we did in the last instance. This is the internal rate of return. Now, if you manually use this rate to discount all the cash inflows, you'll find that the amount of inflows is exactly equal to the amount of investment. So remember, I told you that it's not possible, except by trial and error, to actually find out what my internal rate of return is. But Excel makes it easy. Now, to understand the math behind this, what you can do is you can use Excel to actually find out what the rate of return is. In this particular case, we just found out that it's 8.144. Now, if I actually, take all the inflows here, I discount them by 8. In the first, in this cell, you can see it's 1.08144. If I do this is squared, this is cubed, etc. This is to the power 10, 2.18788. If I take the present value of each of these inflows, and now I add this up, I am going to get exactly 10 lakhs, which is the 10 lakhs which I got here. This is the point I'm trying to make to you, that the internal rate of return will, if you use that as the discounting rate, it will discount each of the cash inflows that you will receive over the entire period of the project. And it will discount it. The total amount which you will get will be exactly equal to the amount of investment. So you see the NPV here is 0. The amount I've received is 10 lakhs, which is exactly equal to the amount of investment that I have made. So this is, all about internal rate of return. And here is the same, another example here, using the same formula. So the point I'm making here is that if you want to accept this project, you will have to be very sure that your cost of capital is less than 8.144%. Okay, now to evaluate internal rate of return, it's similar to NPV. So it considers the time value of money as the cash flows are discounted. It considers all the cash flows over the life of the project. It generally gives the same acceptance rule as the NPV method. Whether to accept or reject, the rule is the same. And whenever IRR is greater than the opportunity cost of capital, the shareholders' wealth will be enhanced. So this is the basic point. I need to invest in projects where my internal rate of return is more than the opportunity cost of capital. If it is more, if my predictions are correct, I will end up increasing the wealth of my shareholders. So with that, we come to the end of our our session on internal rate of return and NPV. And I hope this has been helpful. So we will discuss this again. We will revise this again tomorrow for your benefit, so it makes it easier. But please go through the slides here and please use Excel to do those exercises. You can just try to do what I did. Change the figures, look at how the internal rate of return or how the NPV changes. It will help you to understand how decisions become easier to make for a company using the discounting principle. And we've also discussed the problems with these methods with regard to making correct forecasts. So with that, we come to an end for today. Thank you for listening. See you guys tomorrow.